Hello and welcome to this session. This is Professor Farhat, in which we will discuss risk related to financial statements. Let's first review what is a risk. When we say a risk, what does it mean? It means anything that prevents the company from achieving its goal is a risk. Different companies will have different goals, and each company will have a different obstacle, a different risk that will prevent the company from achieving its goal. It could be a supply chain issue. It could be a shortage of liquidity. It could be a product defect. Risks is anything that will not get you to where you need to get, whatever your goal is. The company's financial statements is different. The company financial statement means when you prepare the financial statements, there are certain risks, and those risks specifically refer to the chance that the financial statements may contain errors or misstatement. Now, the risk, what's the company's goal? The company's goal is to achieve profit. Competition is a risk. But financial statement risk is when you prepare financial statements, and those financial statements, there's a chance something is wrong in those financial statements. It could be error, a mistake. It could be a misstatement. Whether these are due to fraud, we did them on purpose, we made a mistake, or we did not follow accounting practices properly. So these risks, the reason they are risks because they affect the reliability, accuracy, and credibility of financial reporting. The financial statements is to do what? Is to give the users someone accurate, reliable, and credible figures. If those financial statements are misstated, they are incorrect, then there's a risk involved, and we need to refer to these risks. So what are these risks could be that leads to those misstatements? Management accountant, as well as auditors, and especially auditors, they are concerned with three types of risk when it comes to financial statement risks. Those are inherent, control, and detection. Now, in an audit course or on the CPA exam, you need to know inherent risk, control risk, detection risk, and depth, and you need to know how they all interact with each others. In this session, we're focusing on a management perspective and explaining those risks, how they relate to the financial statement from a management, not from an audit, because these three factors determine something we called audit risk. And if you want to learn about that topic, specifically audit risk, and how does inherent, control, and detection risk influence audit risk, you want to go to Farhat Lectures, look at my audit course, or look at my CPA auditing courses. Now, are these the only risks that the company could face? No, there are other risks as well, whether they are directly or indirectly related to financial statements. We will discuss them very briefly, but we will focus today on inherent risk, control risk, detection risk, explaining each one of them separately, given an example, moving on. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Our CMA supplemental course is best for students who are studying for the CMA exam using major course providers such as Glein, Becker, Surgent, UWorld, Hook, as well as other providers. Our comprehensive course includes lectures, multiple choice, true, false, as well as exercises. Start your free trial today, no obligation. We are here to help. Your success starts here.
We will start with inherent risk. So what is inherent risk? Well, inherent risk refers to the vulnerability of a financial statement, item, or transaction to misstatement due to its nature, complexity, circumstances, assuming no internal control are in place. It's a lot of information. Let's break it down. So inherent risk is something has to do with a financial statement, transaction, or an item being misstated, reporting this information wrong. That account is subject to a misstatement. Now, why? Because that item or that transaction is complex, it's difficult, or the circumstances of that transactions are unique, and there are no proper internal control. Now, what are internal control? We're going to see internal control on the next slide. So let's kind of work an example. There are certain transactions, certain accounts that are simple, straightforward, routine. Like what? When you pay your employees every month, the company should be able to control how much they're paying their employees. They will have internal control. They pay them via a check. They know who they are paying because everything is being vetted through HR, and we have a payroll system, so on and so forth. Versus computing the company's pension liabilities. So companies will have to compute, they will have to record a pension liability. Now this pension liability, to compute this pension liability, you have to guess, you have to specifically not guess, you estimate how much you will owe in a pension. Now to estimate this number, here's what you need. You need the employee longevity. How long is the employee going to live after their retirement? Which age they are going to retire? What is their salary growth up till retirement? What is the percentage discount rate we need to use to figure out the appropriate liability? And actuarial assumptions, which is all the above combined. So, did you notice how much information that we have to guess before we can record the pension liabilities? How do you know how long your employees are going to live after they retire? How do you know when they decide to retire? How about if you gave them an early retirement option? Do you know their final salary? All this information is unknown. Therefore, what you have to do, you have to estimate. Therefore, we assume that mistakes could happen because pension liability is inherently a risky account. So mistakes can naturally occur in these calculations due to their complexity, making them prime example of inherent risk. Now, I'm gonna go from inherent risk to an example that's not inherently at all. For example, when a company prepaid their rent, that's a simple, straightforward transaction. When a company pays rent upfront for an office space, let's assume $24,000 for an entire year, the accounting treatment is routine and predictable. What does that mean? It means every month you would recognize $2,000 as rent expense, systematically reducing the prepaid account. Is prepaid inherently risky? Absolutely not. So which accounts are risky? Accounts that are subjective. Subjective means you have to make an estimate. You have to guess. You have to predict. Well, here you're not predicting anything. So that's why not inherently risky. So the simplicity and the consistent reoccurring nature of the prepaid lower its inherent risk compared to other complex judgment like goodwill, financial derivatives, pension obligations, so on and so forth. So goodwill is an asset that you create when one company purchases another company. And goodwill is an asset that you estimate its value based on how much you paid for that company. Then you're really estimating a number. That's what you're doing. Therefore, it's inherently risky. Pension, I told you. So there are certain accounts inherently risky. As a managers, we have to be aware of these accounts. Let's move from inherent to control risk. Now, when we defined inherent risk, we said assuming no internal control. So now we're going to discuss control risk. So let's take a look at this multiple choice question from farhatlectures.com. Which scenario, we have 4 scenarios, illustrate detection risk during an audit? Now we have control risk, we have inherent risk, and we have detection risk. A, auditors fail to identify a fraudulent revenue entry due to limited sampling. Is this a detection risk? And the answer is yes. Why? Because we were trying to do our work as auditors and we failed to detect a problem because we did not sample enough, limited sampling. That's a problem. That's a detection risk problem. Employees bypass internal control by collision. This is a control risk issue. A company experience currency fluctuation affecting profitability. This is operational risk. A firm incur losses due to product recall. Operational risk. So you need to know basically the difference between inherent, control, detection. What should you do now? For more, go to Farhat Lectures for more multiple choice, for more resources. Whether you are a CMA candidate, CPA, accounting student, finance student, studying for a professional certification, the best investment you can make is invest in yourself. Good luck, study hard, and of course, stay safe.